What's up, guys? Your boy Quick Stocks is back. As always, remember to hit those thumbs to recharge my dopamine, and we will get right into the analysis of Alibaba, ticker symbol BABA. As of April 24th, 2020, trading for $204 a share, equating to a $548 billion market cap, and historically speaking, a fairly reasonable PE or price to earnings ratio of 23. Before we get into it, it's important to note we already have a mid-size investment with a whopping 64 shares of Alibaba between our two accounts, equating to around a $13,000 position, with $3,000 of that being profit. So what's the word? Is it time for us to take some profit or back up the truck? This is your quick stock analysis. It certainly makes sense that the world's largest retailer and e-commerce company in the largest manufacturing company would be booming, which is certainly represented in Alibaba's stock chart, being up nearly 146% in the last 5 years. Just to really put this into perspective, China booked nearly $2 trillion in e-commerce sales in 2019, more than 3 times the United States, which is in second place with $587 billion. China on its own represents 55% of the global e-commerce market, nearly twice the share of the next 5 countries combined. And of course, Alibaba has a massive share of this market. Unlike the usual business-to-consumer approach, Alibaba focuses on being a platform for suppliers to sell products in bulk at wholesale prices to small or medium-sized businesses worldwide, who then resell them for a profit in their domestic markets. But of course, there are numerous e-commerce businesses under Alibaba's umbrella, which I'll briefly cover now. Of course, we have AliExpress, who makes money by charging a 5 to 8% commission of the transaction value of goods sold. AliExpress also charges a fixed $1,500 plus store fee. With over 600 million active buyers, this generates a massive revenue source for Alibaba. Next, we have Tobo, which means search for treasure in Chinese. With over 300 to 400 million daily active users, this part of Alibaba's business model facilitates small business to consumer and consumer to consumer trade by allowing businesses and individual entrepreneurs to list their products on their website for sale. One could compare it to eBay, which in fact Tobo became such a massive hit it forced eBay to shut its business in China in 2006. Similar to Tobo, we have Tmall, which hosts over 3,700 product categories, selling to over 500 million active users. And next, just to throw in some spice, we have Alimama, which is the biggest open marketing platform in China. It acts similar to Google's AdSense. And of course, we have Alipay, which is the world's largest e-wallet. And of course, Cainiao Logistics, which is dedicated to meeting the current and future logistics demand of China's online and mobile commerce sector. The company is trying to reach delivery anywhere in China within 24 hours and across the globe within 72 hours. Of course, there are many more e-commerce and e-commerce related businesses under Alibaba's umbrella, but I think you get the point, so let's move on to Alibaba's cloud computing. It's already been proven that cloud computing can be insanely profitable, with the global cloud computing market share expected to reach $623 billion by 2023. And when we look at the data, Alibaba had a 46% share of the Chinese cloud infrastructure market in Q4 2019, and it's important to note China does not operate like the rest of the major markets. Historically speaking, the Chinese Communist Party does not make it easy for outside companies to enter the Chinese marketplace. For this reason, it's hard to imagine Alibaba losing market share, at least in China. And with China's population approaching 1.5 billion people, with massive economic growth taking place, Alibaba's cloud service should see consistent growth for decades to come. It is important to note, not only does Alibaba Cloud have a firm hold over Asia, but it's also operating at a global scale in 55 available zones across 19 regions around the world. In 2019, Alibaba's cloud revenue reached over $3.5 billion for the full fiscal year, an 84% increase from last year, and with a $1.1 billion revenue in the most recent quarter, meaning we should see Alibaba's cloud service well surpass $4 to $5 billion in revenue in 2020. Alright, let's quickly wrap this up. It's important to note Alibaba also owns 33% of Ant Financial, which is the most valuable fintech company in the world. Forgive me for my ignorance, I will do my best at pronouncing these. Sino Weibo, China's version of Twitter. Yoko Todo, similar to YouTube. Aliwong, an instant messaging service. Lewong, a messaging application competing with WeChat. Zhehoson, sales and marketing platform for flash sales for Alibaba's Todo and Tmall. So with all of this in mind, what is our move? And once again, I'm not here to go over the philosophy of investing in a Chinese company. I'm here to look at the numbers, and like I said, we already have a decent sized position in Alibaba and Tencent, another massive Chinese firm, which we took a deep dive into last week. I'll leave a link in the description. Between these two positions, we have nearly a $20,000 position tied to Chinese tech companies, which I am more than happy with. And for that reason, I don't plan on picking up shares unless we see a massive dip in share price. I'm talking sub $160 range. On the flip side, do I plan on selling any of my current position? Honestly, when I built out this position, I built it for the long term. Of course, unless something changes in the business model or in China's policy, as none of my positions are concrete and we reevaluate our positions yearly. But for the foreseeable future, I'm letting this position ride. Anyways guys, that's all we've got for today. If you enjoyed the video, throw some thumbs and subscribe. I'll catch you in the next one. Take care.